Now, Karen Weaver, global head of securitizations at Deutsche Bank Securities, predicts that nearly half of all homeowners with a mortgage will be underwater as prices drop through the first quarter of 2011. She says that any changes, no matter how shallow or short term, though, can always affect the market. And she joins us now to discuss the housing market. And Karen, thank you for coming on the show, first of all. We have seen, since your study, really, a lot of economists say, hey, it looks like we are seeing housing prices stabilize. You point out that there are a few data points in a very short amount of time. But do you see maybe a turnaround here that you didn't see a few weeks ago when you put this out?
Well, I think we have to be careful not to dismiss entirely these green shoots we're seeing. But on the other hand, it is a scant amount of data over a short period of time. It can be impacted by changes in seasonality of the mix, etc. But I'll tell you what is important. What we see is not enough to change our core outlook, which is that prices will fall about 42% peak to trough. But the importance here is around psychology. If you look at the two main reasons people say they're not buying a home, one is they expect prices to fall further. The second is they're worried about losing their job. If people believe that prices have stabilized, if they regain some confidence in the economy, then that psychology is very important to the housing market, where momentum is everything.
And the interesting thing is, you know, whenever Carol and I are talking to people about these supposed green shoots or people who expect a strong V-shaped recovery, I think over the last few weeks about your report, I mean, if prices in housing continue to fall into 2011, and if half of all mortgage holders are underwater, there is no way you could have a strong economic recovery.
Well, and again, this is why our core forecast is not really shaken by this recent data that we've seen, although, again, it's something to watch closely. And the core issue is that we continue to have excess supply in the housing market. We continue to have weak availability of credit, especially at the very high end in the jumbo market and at what was the subprime market. And the supply is going to continue to grow because we know foreclosures are growing. We see delinquencies. Those are rising rapidly. They want to turn into foreclosures. All of those headwinds make it very difficult for a little bit of positive psychology to reverse course in the housing market. But it is a mixture of signals that we're seeing right now.
Now, to be fair, most of the problems that you document, at least now, are concentrated in the sand states, in Florida, in California, Arizona, and Nevada. But you're forecasting that the problems of underwater mortgages will hit the Northeast going forward.
Well, those are the markets where we saw home prices fall first. So in markets like Phoenix and San Diego, home prices started dropping almost 4 years ago. In markets in the Northeast, in many cases, it was more like 2 years ago. So part of it is they just went through the cycle first, in part because they had a lot of subprime and Alt-A mortgages in those areas. And as the rest of the country continues to correct and restore affordability, as we've seen happen in those states, we'll see further price declines. So while today the problems are concentrated largely in, you could even distill it down to Florida and California, eventually it's going to affect the Northeast as well. And then essentially we're talking about most of the U.S. economy. And
just quickly, I want to, you know, the White House has taken a lot of flack for its program to try and help rework these mortgages. But you point out that it's probably not going to help in most of them anyway, and they should just go into default.
Well, what we have to be careful about is how high our expectations are in terms of the ability to modify mortgages. The White House and the prior administration have put out several iterations of programs to modify loans, and in each one, they've improved things. They have created sort of a paradigm for how you decide to modify a loan, sort of a standard. They've created financial incentives for everybody involved in the process. But if you're not sort of giving away the store, you're not going to get huge take-up on this. And so, therefore, it's a partial solution. I think well-crafted the way it's currently constituted, but it's not the end of the problem.
All right. Hey, Karen, we appreciate you joining us today. Karen Weaver from Deutsche Bank.